Bond yields pulled back this week after weeks of climbing. Ontario's HST rebate on new homes is now live, and after 2 years of improvement, Toronto affordability is starting to stall. Here's your Mortgage Minute for a good Friday, April 3rd. Happy Easter and happy Passover to everyone celebrating this weekend.
The 5-year Government of Canada bond yield hit close to its 1-year high late last week, around 3.35. This week it pulled back to 3.089. That sounds like relief for fixed mortgage rates, but several lenders actually raised their rates further this week, even as yields eased. The relationship between bond yields and lender pricing isn't automatic. Lenders make their own decisions on their own timeline. And the bigger picture hasn't changed. We're still well above where yields were through most of 2025, and the whole situation is being driven by the conflict in the Middle East. It's a day-to-day story. Nobody knows which direction it's going to go next. If you're shopping for a home or refinancing and you don't currently have a rate hold, that conversation is worth having now. It costs nothing and locks in today's rates for 120 days. If rates drop, you get the lower rate. If rates go up, you're protected. Last week, I mentioned the HST announcement. As of April 1st, it is real. Ontario removed the provincial portion of the HST on newly constructed homes, making the full 13% exempt on qualifying new builds up to $1 million. That's up to $130,000 off. And this week there was more. The federal and Ontario governments announced $8.8 billion to help municipalities cut development charges by up to 50%. Development charges are fees that get passed directly to buyers. They can account for up to 16% of a new condo's price in Ontario. Combined, governments are estimating savings of up to $200,000 on the cost of a new home. The HST program runs until March 30th of 2027. There's no guarantee it will be extended. If new construction is part of your plans, the window is open now. For 2 years, affordability improved steadily as the Bank of Canada cut rates. That progress is now stalling. In Toronto, buyers still need nearly 62.9% of their pre-tax household income to carry an average home. The quarterly improvement that was running at 1.6 percentage points has slowed to 0.4. The reason is simple. The gains came from falling rates. The Bank of Canada is now holding steady at 2.25%, making prime 4.45%, and expected to stay there through 2026. That tailwind is now largely spent. Further improvement now depends on home prices falling and incomes rising, not cheaper debt. If you've been waiting for conditions to improve slightly before buying in Toronto, the honest message is that the easy part of that improvement is behind us. The math has to work at today's numbers. Connect with me, 249-480-1249, and I'll show you what this week's news means for your specific situation. Have a wonderful long weekend.